3 months ago, a woman named Patricia walked into a mortgage lender's office with a credit score of 621. The loan officer delivered the news she expected. She'd qualify for a mortgage, but the interest rate would be brutal, nearly 7% on a 30-year loan. On a $350,000 home, that rate would cost her over $180,000 more in interest compared to someone with excellent credit. Patricia asked if she could have 90 days to improve her score before locking in the rate. The loan officer smiled politely and said, "Sure," but warned her not to expect miracles. Credit scores move slowly. A few months wouldn't change much. 93 days later, Patricia returned. Her credit score was 761. The loan officer actually asked if she'd submitted the wrong Social Security number. She hadn't. Patricia had simply learned about a mechanism built into the credit scoring system that most consumers never discover. A mechanism that banks and credit card companies understand perfectly but have zero incentive to explain. That 140-point jump saved Patricia over $215,000 in lifetime interest on her mortgage. Same house, same income, same person, different knowledge. What Patricia discovered wasn't a hack or a scheme. It wasn't disputing accurate information or exploiting technical glitches. It was a legitimate feature of how credit scores are calculated, hiding in plain sight that the financial industry profits from keeping obscure. Today, I'm going to show you exactly what Patricia learned. By the end of this video, you'll understand why everything you've been told about building credit slowly over time is technically true, but practically misleading. There's a faster path that the system allows, but nobody advertises. Let me start by explaining why the conventional advice about credit scores keeps people trapped longer than necessary. The standard guidance says to pay your bills on time, keep your balances low, don't open too many new accounts, and wait. Wait years. Wait decades. Let your credit history age like fine wine. Eventually, your score will climb into excellent territory. This advice isn't wrong. It's just incomplete in a way that benefits lenders enormously. Every month you spend in the fair or good credit categories rather than excellent costs you money. Higher interest rates on credit cards, worse terms on auto loans, steeper mortgage rates, higher insurance premiums in many states, larger security deposits on apartments. The credit score tax falls heaviest on people who can least afford it, and the slow conventional path keeps them paying that tax for years longer than necessary. Banks profit from this extended timeline. Someone with a 680 score who could have a 780 score is a more profitable customer. They pay higher rates, they generate more interest revenue. The bank has no incentive to help them escape that category quickly. The loophole Patricia discovered involves something called authorized user trade lines. Understanding how they work requires understanding how credit scores are actually calculated. Your credit score is essentially a statistical prediction of how likely you are to default on a debt within the next 24 months. The algorithm examines your credit history and compares your patterns to millions of other consumers. It identifies factors correlated with default and factors correlated with reliable payment. The single largest factor is payment history. Have you paid your bills on time? This accounts for roughly 35% of your score. The second largest factor is credit utilization. How much of your available credit are you currently using? This accounts for roughly 30%. Here's where it gets interesting. The third largest factor is the length of your credit history. This includes the age of your oldest account, the age of your newest account, and the average age of all accounts. This factor accounts for roughly 15% of your score. Most people assume length of credit history is simply a function of time. You opened your first card at 18. You're now 30, so you have 12 years of history. Nothing to be done about it, just wait. But that assumption is wrong, and the error is where the loophole exists. When you become an authorized user on someone else's credit card account, that account's entire history appears on your credit report. The account's age, payment history, credit limit, and utilization all get imported to your profile as if you'd been part of that account from the beginning. Read that again because the implications are significant. If your mother has a credit card she opened 23 years ago with perfect payment history and low utilization, and she adds you as an authorized user today, that 23-year-old account appears on your credit report immediately. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your longest account history could extend by decades. This is exactly what Patricia did. Her mother had 3 credit cards with a combined age of over 40 years, perfect payment history, and utilization under 5%. Patricia became an authorized user on all 3. Within 2 billing cycles, those accounts appeared on her credit reports. Her thin credit file suddenly looked robust. Her short history suddenly looked established. Her score jumped 140 points. The authorized user strategy isn't a secret to people in the credit industry. Mortgage brokers know about it, credit repair companies know about it, banks definitely know about it. But it's rarely advertised to consumers because there's no profit in shortening the time people spend in high-interest purgatory. Let me share another example that shows how this works across different circumstances. Marcus was 24 years old with a credit score of 589. He'd made mistakes in college, missed a few payments, and maxed out a store card during a rough semester. He was trying to finance a used car, and every dealer quoted him interest rates above 14%. His grandfather had credit cards dating back to 1987, spotless history, combined limits over $60,000, utilization consistently under 3%. His grandfather added Marcus as an authorized user on his 2 oldest cards. He never gave Marcus a physical card or access to the accounts. The addition was purely strategic. Within 60 days, Marcus's credit report showed accounts with 37 years of perfect payment history. His average account age went from 2 years to nearly 19 years. His available credit tripled. His score jumped to 697, crossing the threshold that qualified him for reasonable auto financing at 6% instead of 14%. On a $25 car loan over 5 years, that difference saved Marcus nearly $5,200 in interest. His grandfather's simple action, taking about 10 minutes online, transferred decades of creditworthiness instantly. Let me walk through exactly how to execute this strategy effectively, because the details matter. First, the account you're added to must be in good standing. Perfect payment history is ideal. Any missed payments will hurt rather than help. Utilization should be low, ideally under 10%. The account should be old, with older being better. The credit limit should be high relative to the balance. Second, the primary account holder must be willing to add you. This typically means family members or very close friends. They're giving you access to their credit profile's positive history. In return, they're trusting that you won't abuse any card they might provide. Many people add authorized users without ever giving them a physical card. Third, not all issuers report authorized user accounts to all 3 credit bureaus. American Express, Chase, Bank of America, Capital One, and Discover generally report authorized users. Some smaller banks and credit unions don't. Verify reporting practices before executing the strategy. Fourth, the impact appears within 1 to 2 billing cycles after being added. You don't need to wait months or years. The history imports almost immediately once the issuer reports the account to the bureaus. Fifth, you can be removed as an authorized user at any time, and the account will eventually fall off your report. This makes the strategy low risk for the primary account holder. If circumstances change, they can simply remove you. The mathematical impact varies based on your starting position. Someone with a thin file and short history sees the largest gains. Patricia had only 2 accounts of her own, both less than 3 years old. Adding 3 accounts averaging 14 years old transformed her credit profile's age characteristics. Someone with an established file sees smaller but still meaningful gains. Even going from a 7-year average account age to a 12-year average can add 20 to 30 points. Now let me address the question you're probably asking. Is this actually allowed? Is it legitimate? The answer is unambiguously yes. The authorized user system exists intentionally within credit scoring models. FICO and VantageScore both incorporate authorized user accounts into their calculations. The practice is explicitly legal and officially recognized by credit bureaus. Why does the system work this way? Originally, authorized user reporting existed to help spouses build credit. One partner might handle all the finances, opening accounts in their name only. The other partner would have no credit history despite being part of a financially responsible household. Authorized user status solved this problem by letting the credit-building partner share their history. Over time, people realized the mechanism extended beyond spouses. Parents could help children build credit. Anyone could help anyone else, at least mechanically. The credit bureaus saw no reason to restrict this because it reflects a genuine financial relationship. Some critics have called this a loophole that should be closed. The credit industry has largely ignored these calls because the complexity of modifying the authorized user system would create other problems. For now, the strategy remains fully operational. There are limitations worth understanding. Some mortgage lenders scrutinize authorized user accounts during underwriting. They may discount or ignore those accounts when evaluating your application, even if your credit score reflects them. This is more common with manual underwriting than automated approval systems. Patricia's lender used automated underwriting, which accepted her score at face value. Authorized user accounts carry less weight than primary account holder accounts in some scoring models. FICO has adjusted its algorithm over the years to reduce the impact of accounts where you're not the primary responsible party. The impact is still significant, just not as extreme as it was a decade ago. You remain dependent on the primary account holder's behavior. If they miss a payment or run up their balance, your score suffers. This risk makes choosing the right partner important. A family member with decades of responsible credit behavior is ideal. Let me expand beyond authorized users to other mechanisms the credit system contains that most consumers don't fully exploit. The second loophole involves understanding exactly when credit utilization is measured and reported. Your utilization ratio, the percentage of available credit you're currently using, accounts for roughly 30% of your score. The conventional wisdom says keep it under 30%. More sophisticated advice says keep it under 10%. The actual optimal target is between 1 and 3%. But here's what most people don't realize. Utilization is calculated based on the balance reported to credit bureaus, which typically happens on your statement closing date, not your payment due date. You might pay your credit card in full every month, never pay interest, and use your cards responsibly. But if you're charging $2,000 per month on a card with a $3,000 limit and that balance appears on your statement, you're showing 67% utilization. Your score is being penalized even though you pay in full. The loophole is simple. Pay down your balance before the statement closing date, not just before the due date. If you reduce your balance to $50 before the statement closes, you'll show less than 2% utilization when reported to bureaus. Your score could jump 20 to 40 points almost immediately simply by changing the timing of your payments. This timing trick takes effect within a single billing cycle. You don't need to wait months. Pay before statement close this month, and your updated utilization appears on your credit report next month. The third loophole involves credit limit increases and their surprisingly large impact. Utilization is a ratio. You can improve it by reducing the numerator, your balances, or by increasing the denominator, your credit limits. Most people focus exclusively on balances. The limit side of the equation often gets ignored. Many credit card issuers offer credit limit increases with no hard inquiry on your credit report. American Express is particularly known for this. You can request an increase through their app or website, and they'll often approve significant limit increases using a soft pull that doesn't affect your score. Doubling your credit limit instantly halves your utilization ratio. If you're carrying $2,000 on a $5,000 limit at 40% utilization, getting that limit raised to $10,000 drops you to 20% utilization with no change in behavior. Your score improves simply because the math changed. The optimal approach is requesting increases from all your cards every 6 to 12 months. Each increase improves your utilization ratio and available credit metrics. Over a few years, someone starting with $10,000 in total limits might accumulate $50,000 or more in limits simply by asking periodically. Banks rarely advertise that you can request limit increases. They certainly don't encourage it. Higher limits mean customers can carry higher balances, but they also mean customers have lower utilization and better scores, which leads to those customers qualifying for better rates elsewhere. Banks prefer keeping you at limits that maintain profitability. The fourth loophole involves strategic account management that most consumers get backwards. Conventional wisdom says closing old accounts hurts your score, so never close anything. This is partially true, but often misapplied. What actually matters is the age of your oldest account and your average account age. Closing a relatively new account might actually help your average account age. Closing your oldest account would definitely hurt. The strategic approach involves understanding which accounts to keep and which can be closed without damage. That store card you opened 2 years ago to get 15% off a purchase might be worth closing if it's dragging down your average account age and providing no benefit. Meanwhile, your oldest credit card should remain open indefinitely, even if you rarely use it. Many people keep every account open out of fear, accumulating store cards and random accounts that add complexity without benefit. A thoughtful review of which accounts to maintain and which to eliminate can actually optimize your score while simplifying your financial life. The fifth loophole involves something called rapid rescoring, which most consumers don't know exists. When you're in the middle of a mortgage application, time matters. Improving your score through normal channels takes 1 to 2 billing cycles for changes to appear on your report. Rapid rescoring can update your score within days. Here's how it works. Your mortgage lender can request that credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance and provide proof. The updated zero balance can be reflected within 72 hours rather than waiting for the next billing cycle. Rapid rescoring isn't available directly to consumers. You can only access it through a lender during an active mortgage application. But knowing it exists lets you time your credit optimization appropriately. Make major improvements right before or during your mortgage process, rather than months before when the impact might fade. The rapid rescoring window creates opportunities for dramatic last-minute improvements. Someone who pays off a $5,000 balance mid-application can see their score updated before final approval. Someone who becomes an authorized user on a parent's account can have that account reflected within days rather than weeks. The combination of strategies executed with rapid rescoring can produce score jumps of 50 to 80 points during the application process itself. Before I give you the action plan, let me address the mistakes that sabotage these strategies most frequently. The first mistake is choosing the wrong authorized user account. An account with high utilization hurts rather than helps. An account with any missed payments in its history imports those negatives alongside the positives. An account that's only 3 years old provides minimal benefit if you already have accounts that age. Vet accounts carefully before being added. The second mistake is applying for new credit while executing these strategies. Each hard inquiry temporarily reduces your score by 5 to 10 points. Opening a new account reduces your average account age. People often undermine their optimization efforts by simultaneously opening new accounts that work against them. The third mistake is inconsistent timing on utilization management. Paying before statement close works only if you do it consistently. 1 month of high reported utilization can erase months of careful optimization. Set calendar reminders for a few days before each statement closing date. The fourth mistake is impatience. These strategies work within 1 to 2 billing cycles, which feels slow when you're anxious about an upcoming application. People sometimes abandon the approach before giving it time to appear on their reports. Trust the timeline and verify changes by pulling your reports after 2 full billing cycles. Let me give you a comprehensive action plan for implementing these strategies based on your current situation. If your credit score is below 650, the authorized user strategy offers the largest potential impact. Identify family members with old accounts, excellent payment history, and high limits. Request to be added as an authorized user on 1 to 3 accounts. Simultaneously, address any negative items on your report through proper dispute channels for items that are inaccurate. Pay down any credit card balances to below 10% of limits before your next statement closes. If your score is between 650 and 720, you're in the optimization zone where multiple small improvements can create significant gains. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Consider the authorized user strategy if you have thin file issues or short account history. Check for any old negative items that might qualify for goodwill removal if you have a history of good behavior with that creditor since. If your score is above 720, you're likely fine for most purposes, but optimization still matters for the best mortgage rates. The difference between 750 and 780 might seem small, but translates to meaningfully different interest rate offers. Focus on utilization timing, limit increases, and maintaining the positive patterns you've already established. Regardless of starting point, everyone should pull their free credit reports from all 3 bureaus annually and review them for errors. Studies consistently show that a meaningful percentage of credit reports contain errors, some significant enough to affect scores and loan eligibility. Disputing legitimate errors is entirely separate from the strategies I've described and should happen alongside them. There's a deeper truth underneath all these tactics that changes how you should think about credit scores entirely. The credit scoring system was designed by lenders to predict risk for lenders. It wasn't designed to help you optimize your financial life. It was designed to help banks decide how much to charge you. The system reveals certain information and obscures other information in ways that serve institutional interests over consumer interests. Banks don't explain the authorized user strategy because it helps you escape their high-interest products faster. Credit bureaus don't advertise utilization timing because complexity keeps consumers dependent on credit monitoring services. The whole industry benefits from people believing credit improvement is a slow, mysterious process requiring patience and perhaps paid assistance. The reality is that credit scoring follows mechanical rules. Those rules are knowable. Once known, they can be optimized. The gap between people who understand the rules and people who don't translates directly into wealth differences over time. Someone who maintains a 780 score instead of a 680 score will pay dramatically less interest across their lifetime. Lower mortgage rates, lower auto loan rates, better credit card terms, reduced insurance premiums. The savings compound over decades. These strategies work because you're operating within the system's actual rules rather than the simplified stories told about those rules. You're not cheating, you're not exploiting glitches, you're simply using features that exist by design but aren't publicized by institutions that profit from your ignorance. Patricia's 140-point jump in 93 days changed her financial trajectory permanently. The $215,000 she'll save on mortgage interest will fund her retirement. The knowledge she gained applies to every credit decision she'll make for the rest of her life. That same knowledge is now available to you. The loophole isn't hidden because it's illegal or unethical. It's hidden because nobody with a profit motive benefits from you knowing it. Now you know. What you do with that information is up to you.